It's time for Yahoo Finance's Market Minute. Stocks are falling following another dip in consumer sentiment data. UnitedHealth shares are also sliding, weighing on the Dow on reports the Justice Department is investigating its Medicare Advantage business. United has responded to the report saying, quote, any suggestion that our practices are fraudulent is outrageous and false. Meantime, Coinbase shares are higher on news the SEC is dropping its lawsuit against the U.S.'s largest crypto company. The regulator first sued Coinbase in 2023, claiming it was operating an unregistered securities exchange and failed to properly register its crypto staking program. And Celsius shares surging after the energy drink company announced it's acquiring competitor Alani Nu. And that is your Yahoo Finance Market Minute. For more on what's trending on Yahoo Finance, scan the QR code below to track the best and worst performing stocks of the session.
Welcome to Wealth, everyone. I'm Brad Smith, and this is Yahoo Finance's guide to building your financial footprint. Our community of experts will give you the resources, the tools, the tips, and the tricks that you need to grow your money. Hey, on today's show, portfolio check-in. I'll talk to one portfolio manager who says investors need to, quote, bring an umbrella for 2025. We'll explain what that means. And the wealth of Nvidia CEO Jensen Huang. Ahead of the chipmaker's earnings next week, we're explaining how much the company's top leader is worth. Plus, with news of layoffs at the IRS, we're asking a tax professional how fewer employees could impact the current tax season and your tax refund. We've got all that and much more coming up during today's show. But first, we take a look at some of the action. We're 90 minutes into the trading day. We are down fractionally across the board for the U.S. major averages as stocks are falling to end a volatile week after weaker than expected consumer sentiment data. Joining me now, we've got Keith Gangle, who is the Gradient Investments portfolio manager. Keith, you say that investors should, quote, bring an umbrella for 2025. Explain what you mean by that.
Yeah, we think the last 2 years have been fantastic in the overall market. You know, they're up, 2 years ago, it was up 25%. Last year, again, another 25%. So in the aggregate, the markets have been up 60%. So while we're still favorable for the markets, we think it will get more of that normalized return of that 8 to 12%. We think you need to bring an umbrella. I think we're going to have some kind of corrections as we go throughout the year, a 5 to 10% pullback. Shouldn't be a surprise. So we're warning investors that they need to bring an umbrella, prepare for a little bit of rain. How do you do that? I mean, if you were a 60-40 client, a couple of years ago with the big run up in the stock market, now you're more like a 70-30 client. So what we want them to do is rebalance, get back to that 60-40 where your original plan was. Another way of doing it is we have some structured buffered portfolios that provide some downside protection, but also allow you to participate in the market on the upside. So that's what we mean by bringing an umbrella.
With that in mind, this has been an interesting week because, of course, we have more news coming out of DC and policy decisions that are rolling out. You also have more earnings reports. And then amidst all of this, you still have the NASDAQ and the S&P 500 still notching some new record highs. Of course, we're moving off of those levels today. But what does that tell you more broadly about how this market is weathering some of the larger kind of events that could prove volatile?
Yeah, it's pretty impressive with all the negative news that you just talked about that the markets haven't been selling off, especially, again, after we had these nice big run. The S&P, year to date, it's almost up 4%, even with all this news. But I think the market investors are looking through it. If you look at the earnings forecast for this year, expectations are for 14 to 15% EPS growth this year, followed by another 14 to 15% next year. We think that's a little too optimistic. We think it's more maybe like that 8 to 10%. But again, even with an 8 to 10%, that's a good backdrop for the stock market. I think that's what investors are looking at. They're looking at that earnings growth potential and unemployment rate's at 4%. So if consumers are working, they have money in their pockets, they're spending, I think that's going to continue driving the markets forward.
All right, what's driven the market so far and over the past 2 years has really been this Mag 7 trade. However, you're looking at 6 names specifically and taking one out of that basket, and that's Tesla. Why is that?
Yeah, Tesla, I think, is pure on valuation. It's a name we like. They're very innovative. Musk's got a lot going on right now, but it's a name we don't want to own here. We think valuation's too expensive. The EV market's coming under some competition. We haven't seen where batteries are going. Robo-taxis is still on the come, and I think that's what everybody's betting on. But that could end up getting pushed out to the right, so we want to wait for the stock to come in a little bit more before we get interested in it.
And so with that in mind, how are you kind of positioning for yourself right now, looking out into the back half of this year where we're going to be waiting for some of the interest rate decisions as well from the Fed?
Yeah, so we think the market can start broadening out. The last 2 years almost been driven, solely by the Magnificent Seven names just, running high. So we think obviously you still want to be involved with those names, but we don't own Tesla. We own the other six. You want to still own them. Just probably maybe own a little less than your benchmark. And I think the market's going to continue to broaden out. You want to look at names like healthcare, some industrials, things like that.
You're also looking at Netflix, Dexcom, Palo Alto Networks, and a company that also just reported this week, Walmart. Just walk us through your kind of top pick thesis on these names.
Sure. We like leaders in the space. And the first one you mentioned, Netflix, they had a phenomenal quarter, big beat, had, big numbers on their sub ads. So that's a name we continue to like. They're the leader in the streaming space. Everybody's chasing them. We think they can hold that premium multiple. And again, as ad revenue kind of builds on their new model, we think that's a good thing for them. You mentioned Palo Alto. They had a really good quarter. Again, they're a leader in the space. Everybody's looking for security. With all this new AI play, they're going to be the beneficiary there. Walmart's the one that disappointed, those names that we just talked about. Again, they had a good quarter. Guidance was subpar. They took EPS down by about 8%. That's why the stock went down. Stock is not cheap. Now, we have to keep an eye and see if the consumer's actually getting a little bit pinched with some of the stuff like high interest rates. Are the consumers starting to put more on their credit card? That's something we have to continue to watch. But I think Walmart's taking share, so we still want to be involved with the name as well.
Keith, thanks so much for taking the time here.
Thank you.
Now time to dig into today's top trending ticker on Yahoo Finance. You can scan the QR code below to track the best and worst performing stocks of the session with Yahoo Finance's trending tickers page. It's an active one. Let's take a look at UnitedHealth Group, responding to the Wall Street Journal report that claims the Justice Department is investigating the company's Medicare billing practices. UnitedHealth Group says the journal, quote, continues to report misinformation on the Medicare Advantage program, end quote. The healthcare company says that the government regularly reviews all Medicare Advantage plans for compliance, and they are not aware of the, quote, launch or of any new activity. UnitedHealth says any suggestion that their practices are fraudulent is outrageous and false. The journal's report claims the new civil fraud investigation is examining UnitedHealth's practices for recording diagnoses that trigger extra payments to its Medicare Advantage plans. Shares of UnitedHealth Group are falling on the day. Nvidia's fourth quarter earnings are on deck, but the results may not be as important as they've been in the past. Yahoo Finance's Julie Hyman is here now with a closer look at what they mean for the broader market. Hey, Julie.
Hey, Brad, thank you. Well, part of this is just because of the action that we have seen this year thus far, where the contribution of the Magnificent Seven, including Nvidia, has really fallen relative to the rest of the market. That's in part because of underperformance of those names and in part because of the broadening of the types of stocks that are doing better. This long-awaited broadening that a lot of investors have been calling for a while. So Yahoo Finance crunched the numbers. This is as of Wednesday's close, so we might have seen some tweaking since then. In terms of the biggest contributors to the rally this year in terms of the market cap gains. Now, last year, it was Nvidia unquestionably, and all of the others were members of the Magnificent Seven: Apple, Amazon, Meta, Alphabet. In terms of their size and the magnitude of the gains, they contributed the most to the S&P 500's gains. In fact, for the Magnificent Seven all together collectively contributed more than 50% of the gains for the S&P 500 last year. This year, it's a very different story. Yes, Meta's still number one at around 13%. Nvidia's at number two. We'll get to its percentage in a moment. But then you got Walmart at number three. You got JP Morgan Chase at number four. Eli Lilly is on the top 10 as well. So it is a more diverse, beyond big tech list of stocks that's doing well. For Nvidia specifically, last year it accounted for 20%, just Nvidia alone, of the gains in the S&P 500. This year, it's a little more than 5%. So it's not that Nvidia is not important. It's just on a relative basis, it's less important. Just another way to slice and dice this, to look at the broadening trend that we have seen, is to look at the S&P 500 year to date, which is market cap weighted. That is, companies like Nvidia and Apple have a bigger weighting, a bigger influence. And then if you equal weight it and look at the year to date, it's pretty much neck and neck. There was a big gap between these two last year. So just again, gives you an idea of the closing of that gap that we've seen. So that's part of it. And then part of it is also just that NVIDIA is not wowing us quite to the same extent than it was when it first began wowing us as it was first catching fire with the demand for generative AI chips, right? So if you look at the company's revenue trajectory, really started taking off in 2023 in its reports then, and we were seeing triple-digit gains. The revenue gains, by the way, peaking right around 260% here. And that was, if you look at the quarter when that happened, that would have been its fourth quarter of 2024, fiscal fourth quarter of 2024. It's on a bit of a different calendar. Now, the estimate when it's coming out with its numbers next week is for revenue of $38.26 billion. That's still a 73% gain. It's all relative, right? It's still a 73% gain, which is a big gain. It's just not sort of the heady, huge triple-digit gains that we had seen from NVIDIA in the past. And, you know, we did see NVIDIA fall a couple of quarters ago when it reported. Last quarter, the stock was a little changed. So we'll see what kind of halo and ripple effect it has this time around. Again, it's not that NVIDIA isn't important. It's just that it has become less important as we get this broadening. And then finally, just want to take a look at the stock action in NVIDIA, if we could get it to come up. The stock action in NVIDIA that we have seen year to date here. So here's NVIDIA. The stock is up about 3.3% year to date here. Here's today's action. You know, so it is higher year to date, but its record high was back on January 6th, and it has not reattained it since that date. So again, just something to put things in perspective as we await those earnings after the close next Wednesday, Brad.
I've got my kitchen timer set. It's on the max numbers that I can put it on for that countdown. Thanks so much, Julie. Nvidia is the second largest company in the world by market cap at $3.4 trillion. It was founded in 1993 by three people, including current CEO Jensen Huang. Since its IPO in 1999, shares have risen more than 300,000%, with much of the increase happening in the last 5 years. The company has led the AI boom on Wall Street. Jensen Huang has served as president, CEO, and a member of the board since the company's inception. Huang is currently the 13th richest person alive, according to Bloomberg's Billionaires Index. He has a net worth of $119 billion, trailing other big tech CEOs like Elon Musk, Mark Zuckerberg, and Jeff Bezos. The majority of Huang's wealth comes from his 3.4% stake in Nvidia. That shakes out to about 837 million shares worth around $117 billion. The other $2 billion of his net worth is in cash and other assets. In 2025 alone, Huang's net worth has grown by $5 billion. We will have special coverage of NVIDIA's fourth quarter earnings report Wednesday, February 26th, starting at 4 p.m. Eastern Time on Yahoo Finance. Well, the IRS is reportedly laying off more than 6,000 workers, the latest cuts in the Trump administration's efforts to reduce federal bureaucracy. But the layoffs come at a critical time for the IRS, the 2025 tax season. Here with more on how cuts could impact your taxes and your refund is Tom Osabin, who is the Director of Tax Content at the National Association of Tax Professionals. Tom, good to have you here, and thanks for taking the time to help us break this down. What kinds of issues could we see with the IRS layoffs taking place at the beginning of this tax season?
Yeah, the timing is really ill-timed. Can easily say that as we're getting into the heart of the tax filing season now. So I'm likening it in some ways to back during COVID when people had to work from home or there were stay-at-home orders. And we gave similar advice then, and I'm going to give it now. I'm a tax professional, been one for more than 30 years. It's no different what I do that I would say to someone out there who's going to maybe work on their own return this weekend. And what you want to plan to do, this layoff situation could in fact be a non-event to a lot of individual taxpayers if they, number one, commit themselves to try to avoid person-to-person contact at the IRS. In today's tech-heavy world, just had a great discussion about all of the tech stocks and how they're doing. The notion being electronically filed, just as we're seeing here on the chart. So put your data together, and if any possibility, electronically file. But before you press send, be sure to review all that data and make sure it's accurate so it'll be in the system and processed like normal. double check those social security numbers and the names. If you had a dependent perhaps that was born late in 2024, do you have a social security number yet for that child? You know, when I meet a new client, the first thing I do is I look at last year's return. So even when you're sitting there doing your own return, start with last year and make sure you've got good data that you're putting in. Make every attempt to electronically file, either through commercially available software, your tax professional, the IRS free file program, and try to make sure that you've got good information going in. I would also suggest to set up for direct deposit. What do you need to do? Double check your bank routing number and account number before you press submit, because that'll be another way to avoid making sure we don't have to have person-to-person contact before everything goes awry. Now, one thing also to do to help to not clog the phone lines, use the IRS Where's My Refund tool, as opposed to calling the 800 number, which you're going to be very, very frustrated and you're going to be on hold for a long time. Use the Where's My Refund tool. Realize that even after you get a confirmation back from your software, it's going to take several days, if not more than a week, for that data to be available on the Where's My Refund tool.
Right.
So from that standpoint, patience is a virtue. And again, you're trying to avoid, I'm sorry, go ahead, but I was just going to say, patience is a virtue. Be prepared for long waits if you're going to have to call.
And so is there any potential impact as a result of the layoffs to people's tax refunds?
So far, we haven't heard that. Most of the returns are processed in an automated fashion, so that's the good news. If for some reason a return is kicked out, I will tell you that long ago I was taught that a tax return is kind of like a health insurance claim. The difference is a health insurance claim is reviewed pending acceptance. IRS submissions of returns are accepted pending review. So the things that would cause a later review of a return don't happen in the electronic submission process. There's only a couple of ways that a return would fail. One being social security numbers and last names don't match. That will kick a return out of the system. If you happen to purchase your health insurance on the marketplace and you didn't enter the data from that Form 1095A, that will cause the return to immediately reject. So you want to make sure you've got that information, just as we showed in the slide a moment ago, as to having your data good, you have everything together, and you submit a clean return. Garbage in, garbage out is the old saying.
What if people have concerns about data breaches? What's your advice there?
That's always a concern. And, larger companies than mine have certainly been hacked and all of those issues. The IRS has the ability to get what's called an identity protection PIN. Now, in years past, you have to either be a victim of identity theft or feared you were, in order to get one. Now, anybody can. So if you've got the nuclear family, husband, wife, 2 children, you can each have an identity protection PIN. You go to the getanippin.com, which is part of the IRS website, and you can get that set up. That will provide another layer, almost like multi-factor authentication, another layer that the bad guys have to get through, and I always describe it as the keys to the candy store. If the bad guys can get a match to the first 4 letters of your last name and your social, they're in. But if they've got one more layer they've got to get through, that being that identity protection PIN, one more step to make your data more protected. One other thing I want to throw out to you as we're talking about the potential for data breaches, if people have anxiety right now, there are bad guys out there that prey on that anxiety. Don't bite on emails that you get that say, we'll help you get your return through. Listen, if it's unsolicited, it's going to be a problem and probably cause you more problems down the road.
Tom, thanks so much for taking the time here. Really appreciate it.
Thank you very much.
Coming up, ChatGPT versus Claude. And don't forget about Gemini. We're talking to an expert who tested all the major AI chatbots out there to tell us which one you should try next. A year ago, in March of 2024, Pew Research found just about a quarter of U.S. adults had used ChatGPT. By November of 2024, OpenAI CEO Sam Altman said the company was up to 300 million users per week. But OpenAI has competition. Google, Anthropic, and X all have their own generative AI chatbots. Sabrina Ortiz, ZDNET AI reporter, tested them all and joins me now in studio to break down what she found. Great to have you here with us in studio. So first, let's start with OpenAI, perhaps the chat daddy of them all, if you will. With this particular chatbot, what have you found, and ultimately, what's the takeaway?
Yeah, so like you said, OpenAI is dominating the space. It's the name that most people are familiar with. Most households, I think, they hear AI chatbots almost synonymous with ChatGPT, and that's for good reason. It is a very, very capable chatbot, and even in its free tier, it has robust offerings where anybody that's a casual user or just interested in experimenting with the chatbot could get a lot of really powerful tools. So it is still a chatbot dominating the market, and it is a great option.
Okay, and so what we've often talked about is the fact that these chatbots could replace search, and the name that is synonymous with search is Google, so much so that it's essentially a verb at this point. So they have their own chatbot, Google Gemini. What have you found there?
Yeah, so when Google first entered the space, it was a bit of a dark horse, right? It started with Google Bard, and Google Bard was a bit of a flop. It didn't quite meet those expectations, but then it quickly pivoted, it rebranded, and then it launched Gemini. Gemini is actually a very, very capable tool, and like you said, Google's synonymous with search engine. So they have a unique position in that when people are Googling, they will, I'm sure you're familiar, you make a search and you see an AI overview. That's powered by Gemini. So not only is it a capable tool, but it's also able to reach people really easily through products like Google Search, right, or in Samsung Galaxy phones, or on Google Pixel phones, or even tools like Google Meet, which a lot of people already have in their workflows. So not only is it a great chatbot, but it's also really easily accessible by people, which I think makes them a very, very competitive chatbot in the market.
Also proves that maybe getting the name right is key to this as well here, because we weren't buying Bard for a little bit, but Gemini, we can start to get around that a little bit more. Also, speaking of names, Claude, we got to talk about this one. This one's from Anthropic.
Yes. Also a really great option. And what makes them unique is that a lot of people, when they hear chatbots and they hear AI, they're hesitant. And because of security and privacy concerns, particularly because you're inputting your data, right? So if you are using it in your workflow, you might be using some sensitive business data. Or even if you're using it for your own personal documents, you might not want that information then used to further train the model. So what Anthropic did from the beginning is they said, we are not going to train our models on your input data. So this really helped build, trust of consumers. And I think that's where that appeal is. So you'll hear a lot of people are gravitating towards Claude, also a great option in terms of performance, but also that unique appeal is really what's drawing, I think, people, and its unique competitive edge there too.
Okay, got to hustle to my finish here. We got a few more, a couple. Grok 3
Yes.
from Elon Musk's X. What do we know about this one?
Yeah, so Grok 3 actually just launched on Monday, and it's much more powerful than both of its predecessing models, and it is actually super, super competitive. Upon launch, usually what these companies do is that they release the benchmark results, comparing it to the other leading market models, and the benchmark results show that it's actually blowing competitors, including Google, including OpenAI, out of the water. And most interestingly to me is in the chatbot arena, which is this crowdsourced platform where everybody, like from the public, can chat with two different chatbots, not knowing the name to them, and then vote. Grok, an early version of Grok 3, was put on that chatbot arena, and people voted. It was under the codename Chocolate, not knowing. So it's not like, oh, there was a bias knowing it was, XAI
right,
or Grok or anything, and people were voting, and it actually went all the way up to the top of the leaderboards.
Wow.
So yeah, it is showing a lot of promise. I haven't gone hands on it myself because it just launched, but actually yesterday announced that it is rolling out to free users. So if free users want to try it out and see what the hype is about, they can.
Okay, all right. Lastly, before we let you go, we got to know, what was the prize-winning bot right now?
I know that this might seem a bit predictable, but I'm still going to give it to OpenAI's ChatGPT. Okay. Again, just because in that free tier, it has so many offerings that I think everybody could take advantage of. And also, it's developing so many models so quickly, and perhaps I think the quickest, and it's setting the pace for the rest of the market. So if you want to be ahead of the curve and on track with all the cutting edge technology, I think that's a great option.
Sabrina, thanks so much for taking the time here with us in studio.
Thank you so much for having me.
Appreciate it. Coming up, everyone, why the traditionally robust spring selling season could be tough for home builders. Plus, Do you have too much house? We're giving you tips for downsizing. That's coming up next. Typically, the spring marks an uptick in the number of homes sold across the U.S. According to the National Association of Realtors, an average of over 18,000 homes are sold per day between April and June. But this year's season could be a bit challenging for home builders. Here to tell us why, we've got our own Danny Romero. Danny, good to have you here in studio. What are some of the challenges that lie ahead this spring selling season?
Spring is the busiest time of year for the housing market. And, the season usually starts right after the Super Bowl and runs through May and June. And so this is a time of year where homes are sold at top dollar. They're also sold quicker. But we're already seeing the challenges, specifically for the home builders. We're starting to see some of those cracks. For example, D.R. Horton, they just reported their earnings, and they reported a 1% drop in their net orders in their first fiscal quarter this year. And so to help boost some of these sales, D.R. Horton has actively been offering mortgage rate buydowns. That's when the builder upfronts the cost to lower the rate on the loan. But at the end of the day, that impacts their margins. And so another home builder this week, Toll Brothers, is feeling those challenges. They lowered their guidance for home deliveries. And so some Wall Street analysts have come forward and said, hey, the challenges go beyond just demand. And so the bigger headwind here is rising land prices and also a more competitive selling environment. So just to give you some context on how competitive it is out there when it comes to the inventory aspect, data from the National Association of Home Builders reports a 46% increase in the number of completed, ready to occupy new homes. So that means new homes make up 30% of the homes for sale. And just to top it all off, President Trump's tariffs could add more price pressures, not only to consumers, but also to the builders.
Yeah, we had the National Association of Home Builders CEO, Jim Tobin, on with us yesterday. He laid out a lot of what you just ran through there a moment ago in the dynamics that they're seeing in the market right now, too. We know you're going to continue to keep close tabs on this, Danny. Appreciate it. 43% of baby boomer homeowners say that they'll never sell their current homes, according to Redfin data. So for the other 57%, how do they downsize from the family home of their younger years as they approach retirement? Joining me now, we've got Kathy Casey, who is a residential brokerage realtor at Coldwell Banker. Great to have you here on the show with us. So let's talk about this a little bit. For those empty nesters who are trying to downsize just a little bit, where does the thought process begin?
So I think the thought process really begins in, what do you want your golden years to look like? As you know, you may have heard the Surgeon General declare that loneliness is becoming an epidemic. And, so especially for seniors, if you're not working anymore, you may be missing your sense of purpose. So what do you want your senior years to look like? Are you moving towards family? Have you considered being into an active 55 plus community where you can be part of a community? If not that, then perhaps consider, somewhere where you worship, or somewhere where you can volunteer for worshiping, or some other activity where you can be involved and just feel like you have purpose in your life. Yeah. So that's where I would start as far as that. And then as far as the home itself, I would get your realtor involved early because the family homes tend to be a little dated for the market. So you want to know what you'll need to do to get it ready for market. You definitely want the Brady Bunch, effect going on market right now. Then, start with decluttering because when you've lived in your home a long time, then, you have more stuff than you ever imagined that you have. And it just takes longer to get ready. Last thing yeah.
No. And the last thing, I believe, in these tips for downsizing your home, what is that last consideration and the questions that you need to consider about where you live as you were running through?
So the questions you need to consider about where you live, you have to take in mind, you're going to be able to get out and exercise. All those things, are you going to be close to family? All those things are things that you definitely need to consider, as well as what the financial implications of them are going to be. Getting your realtor involved early, I think, is very helpful. You want to also make sure that you, because you're going to be getting rid of a lot of stuff, make sure that you find that you preserve the memories you want to, either digitally or some other form. Um, and also, when you're getting your realtor involved, because even though your house may be up to date as far as fixtures and everything, but sometimes the furnishings are older and it'll make your house look dated. So you want to make sure you get that. Yeah.
What are your tips for retirement era housing as well, for those who are finally getting into retirement and want to make sure that they're taking the right considerations for the home?
Yeah, I think that really needs to be on an individual basis. For some people, if you're making if you've been in your house a long time, let's say it's almost paid for, so you've got a great big next day coming from the sale of your home. Does it make sense for you to buy something else? It may not. It may make more sense for you to get involved into a co-op or something like that. That's, going to be more economical and doesn't require a whole lot of maintenance. So I think you have to take it at the first come, first served basis and see what really makes sense for you in your particular situation.
Certainly. Are there areas that you're seeing be hotspots for retirees who are considering that downsizing?
Oh, always. Always the warm spots are always, the places where people want to go, Florida, California, always somewhere warm is always more inviting. Like today we're in Colorado and we had snow this morning. So a lot of times you don't want to deal with that as you're, aging, shoveling snow and all that. So that's always the hot spots for people in retirement.
Kathy, thanks so much for taking the time. Good to see you.
You too. Thank you.
Coming up, with inflation ticking higher in the past month, we're taking a look at one asset that you might want to consider. That's next. Inflation ticked higher last month, with the headline figure rising 0.5% from the prior month. Inflation is up 3% from the year prior. Investors may be wondering how they should account for inflation in their portfolios, and today we're going over one asset that could serve as a hedge to inflation, and that is Treasury inflation protected securities, known as TIPS. TIPS are a type of treasury bond indexed to an inflationary gauge to protect investors from a decline in the purchasing power of their money. Here with more and the fuller breakdown, we've got Jeff Johnson, Vanguard Head of Fixed Income Product. Jeff, please explain how TIPS work and when they're beneficial to someone's portfolio.
Well, hi, Brad. Thank you for having me on. Well, the first thing we got right is the name. They're Treasury inflation protected securities, typically known as TIPS, and not to be confused with the sort of tip that we're all increasingly asked for when we use our cards to pay for various purchases. TIPS are real interesting as an asset class for investors who are looking to hedge out inflation risk from their portfolios. And the way they work is roughly 10% of the Treasury securities that are issued by the U.S. Treasury have a link to inflation where the principal value is adjusted for the rate of inflation over time, in addition to paying a coupon rate and an interest income just like any other bond.
So what are the risks of investing in TIPS?
The risks of investing in TIPS are similar to the risks of investing in other types of bonds. TIPS are still a bond, which means that when interest rates go up, that means that TIPS prices can fall. And we've certainly seen that over periods of time historically. So for those investors who are looking to hedge out their inflation risk, they need to be mindful that TIPS prices can fluctuate. The main way that they can combat that, though, is by choosing the inflation-protected fund or ETF that best aligns to their risk tolerance or time horizon. Shorter-term TIPS strategies like the Vanguard VTIP ETF have much less expected price volatility than a longer-term strategy that might offer a higher yield, but that would be expected to come with a little bit more price volatility.
And you have three considerations for people out there who are watching for investing in TIPS prior to adding them to your portfolio. What are they?
Yeah, it's the question around how to think about TIPS really comes down, first of all, to time horizon. So an investor needs to think about, how long is their time horizon? If they're looking to hedge out an inflation risk that's coming in the next 2 or 3 years, they should probably think about a shorter term option. If they're thinking about saving for an extended period of time and a investment outcome that is 10 or more years out in the future, they can consider a longer term TIPS strategy. A second consideration for investors when it comes to TIPS is the expected inflation rate. So investors can actually look at this asset class and think about what kind of inflation do they expect. Today, the 10-year Treasury yield has a rate of around 4.5%, and the 10-year TIP has a yield of about 2%. That means that the market's expected inflation rate is about 2.5%. For investors who are worried about inflation being higher than that, TIPS actually could make a lot of sense for them in their portfolio. And the final consideration is TIPS act a lot like insurance. And just like we buy insurance in advance of worrying about some sort of adverse event that could affect our lives, TIPS work a lot the same way. And that means that it's really important to have TIPS in your portfolio strategically, because when that inflation arrives, if you wait to buy TIPS until after inflation occurs, it's probably too late. So it really needs to be a strategic component of investors' portfolios based on how much of a risk factor they view inflation as in their portfolio.
Certainly. Is there kind of a rule of thumb return that you should be looking for on your TIPS investments?
Yeah, the way to think about the expected return on TIPS is that you start with a stated interest rate or coupon on the TIP security. So as I said today, a 10-year TIP has a yield of about 2%. Now, over time, if held to maturity, that bond should return 2% plus whatever the rate of inflation turns out to be over the course of the next 10 years. The market is pricing that in to be about 2.5% today. So for an investor who allocates to TIPS today for the long term, they might expect a 4.5% or so return against an environment where inflation has been about 2.5%, thus providing them with a return of about 2% over the rate of inflation. That is the whole idea of investing in TIPS.
Jeff, thanks so much for breaking this down. Appreciate it. Anytime.
Thank you.
According to Fidelity Investments, Americans have an average of over $100,000 saved in their retirement accounts. But is that really enough to thrive? Here to break down how much you should be aiming for is Ross Mack, financial expert and host of the Financial Freestyle. Ross, good to have you back here in studio. So how much should Americans be aiming to have saved at every age here?
Yeah, well, one, right? Retirement is going to creep up on us, right? That's the one thing we never want to think about, right?
I hope it comes faster.
Well, I don't know. Well, I would like to retire yesterday
Yes.
at this point. But I think a general rule of thumb is by the time you get to 30, you want to have 1 times your salary saved. And then now when you get to 40, you want to have 3 times that. When you get to 50, you want to have 6 times that. When you get to 60, that will be 8 times. And then once you get to actual retirement age of 67, you would like to have 10 times your annual salary.
Okay, so if those numbers sound intimidating, how do you go about actually achieving it over time?
Yeah, at the end of the day, right, the best time to plant a tree was 20 years ago. The second best time is today, right? And so I think when it comes to actually saying, okay, I'm a little bit behind on my retirement planning, how can I actually get there? So one, increase your investments, right? Like at the end of the day, you want to at a minimum target, 15 to 20%. If you're already at 15, let's go to 20. And now you'd say, where am I actually investing, right? If it's in your 401k, make sure you're taking advantage of your employee match program. You want to get that free money to effectively double your return in that short time, right? And I think another thing is actually see what you're invested in. I think that's very important. The average person just says, I've had people tell me, I'll put money in my Roth IRA. Now what? Oh, well, it's just sitting there. It's not doing anything. So one, know what you're investing in. Alternatively, you could also look at what you're investing in your 401k because, the average person is probably using a target date fund. And that's kind of a general one size fits all thing. And it, for the most part, doesn't work. Yeah. Right. And historically, I don't want to, talk down on it, but like historically, the returns aren't as good. And when you think about it, right, it makes sense to get a little conservative as you get closer to your retirement age. However, it might, bode well to actually take on slightly riskier investments, more just ETFs, growth ETFs, S&P 500, just to call it simple. And I think another thing is also alternative methods of some streams of income.
Absolutely. Ross, thanks so much. Appreciate it.
Oh, man.
For more great advice, you can listen to new episodes of Financial Freestyle Mondays at noon Eastern Time. Coming up, how to save money on childcare costs. We've got tips for parents next on Wealth. A programming note on today's episode of Warrior Money. Patrick and Dan speak to the CEOs of Parlay Finance and Torch Warrior Wear. They share advice for entrepreneurs looking to raise capital and find customers.
I would almost argue you're never done.
No, you're never done.
And so like as you build more and learn more, your position or hypothesis becomes more advanced, but the new frontier of your limit becomes where your learning drives next. So I think there's a lot of power in making sure your company is designed to be really rigorous about learning what is real, not what you want to hear. I want to give a shout out again to our CTO, James Cho here. He's really disciplined about, there's a book called The Mom Test, the art of listening so that you drive learning and not that you reinforce biases that can potentially distract the trajectory of your business.
You can watch new episodes of Warrior Money every Friday, 12:30 p.m. Eastern on Yahoo Finance or wherever you get your podcasts. A recent survey from Care.com shows that the average parent juggles 5 different loved ones and care arrangements between children, aging parents, and pets. And yet, 48% say they don't have enough help. And this leads to caregiving stress. 90% report losing sleep. 80% say they've cried. Hey, that's okay. 71% experiencing health issues. We got to rectify that. Parents attribute much of their stress to affording care. The survey says parents spend 40% of their household income on care costs, with 22% on child care alone. The latest CPI print shows tuition, other school fees, and child care prices are up 3.6% from last year. Our next guest has a specific ethos around this topic and helping parents, and that is time is money. Here with more, we've got Letitia Barr, who is the parenting and education expert at Brainly. Letitia, great to have you here on the program with us. Can you just explain your thinking around helping parents manage child care costs?
Sure, absolutely. Well, thank you for having me. And as a mom of 2 college students, I know when we think about childcare, it's not just at the youngest ages where we're considering childcare costs. Certainly when our kids are toddlers and preschoolers, our costs are different. But as our kids get into elementary, middle, and high school, those costs change in terms of what we want to provide to them in terms of giving them the best education possible. So when we think about childcare, one way parents of preschoolers might be able to save on childcare is doing things like coordinating with neighbors to share childcare responsibilities through a nanny share or sitter share. This helps reduce individual costs for after-school care and summer supervision, while ensuring that your child is in a familiar and trusted environment. But also as your kids are getting older, elementary school ages and older, and they're struggling with homework, they're working to understand concepts, we're thinking about things like tutoring. And tutoring can be a huge cost for families. And I live in the Washington, D.C. area where a lot of the recent administration changes have affected families in our area, and people are looking to cut back. And that includes things like private tutoring and things like, for our older kids in high school, SAT and AP prep. So one really great way that families can save on those costs is to search out free tools. And using free online tools, such as tools like Brainly, can be a great free way that parents can ensure that their kids are being academically successful at no cost. So Brainly is a free AI tool that provides for free their community answers and their test prep experience. It's all 100% free on Brainly.com.
Wow. Okay, so you sent over 3 tips based around this idea of time is money to help parents manage costs. What are they?
So time is money. First of all, use your network of parents, right? Everybody wants to have a date night. Everybody needs time for themselves. In those statistics that you showed earlier, stress can be huge for parents. So coordinate with families in your area to reduce the cost of childcare. Rotate those childcare duties so you get a break. And older children, be strategic about their time off work. So time is money in terms of helping our kids be academically successful. If your kids can access free tools like Brainly to complete homework before you get home, I know that eliminates a lot of the struggle around the dinner table and beyond that comes with helping kids with homework. So kids can independently access Brainly both on the web and through their free app. They can get 24/7 homework help, test prep help. It can help them manage their time. And that for you as a parent takes a lot of stress of helping your kids when you get home from work so you can enjoy that family time with your kids.
Letitia, I got to hustle to my finish here, so I got 45 seconds. But how are you seeing families and parents specifically navigate child schooling costs right now?
Child schooling costs can be tough. I know as a parent of 2 college students that is a huge cost. Costs are going up, and families who are being laid off and furloughed, that's a big challenge. So I encourage parents to be knowledgeable about free tools like Brainly in order to help their kids and to be academically successful if you're having to cut back costs.
Letitia, thanks so much for taking the time here with us. Appreciate it.
Thank you for having me.
Let's do a final check of the markets as we're taking a look at the major averages. We are down fractionally across the board. The Dow lower by about 0.9%. The S&P 500 down 0.6%. NASDAQ Composite down 0.8%. That's it for Wealth, everyone. I'm Brad Smith. Thank you so much for watching. You can stay tuned for Market Domination. That comes up 3 p.m. Eastern Time. They'll count you down to and through the market close. You don't want to miss it.